Getting an SBA loan is one of the most effective but also misunderstood strategies in business. As someone who used SBA loans for multiple deals and has helped hundreds of my students use this exact same process, I am going to be walking you through a full, no BS guide on how to get your first SBA loan done. If you have found other guides online that are overly confusing or technical, trust me, this is not going to be one of those. So let's talk about what an SBA loan actually is. SBA stands for Small Business Administration. So think about an SBA loan the same way that you might have for a VA loan when it comes to real estate. These banks, they're not government banks. They are private banks that are giving out loans for people to buy acquisitions. But then the SBA, which is a government organization, comes along and says, hey, we want you to give out more loans. Because of that, we're going to guarantee that a portion of that loan you give out, we're going to back you. So in case that business fails and the buyer who took out the loan does not pay you back, we're going to pay you back for a portion of that loss. So now the bank says, great, now our risk just got greatly reduced because now we have the federal government saying that they're going to back us on a percentage of this loan. So we're going to give out more leverage to these buyers. Therefore, more deals get done. And so it's a way to stimulate the business acquisition community for small businesses. Now, there are still criteria that need to be met in order to qualify for an SBA, specifically an SBA 7A loan. Now, here's the criteria. First off, you have to have a credit score that's above a 600. Now, it's possible to get a deal done or to have the SBA lender give you a loan with lower than a 600, but you're going to have to really have a lot of assets to back that up to use as collateral for the deal. So typically you want over a 600 credit score. You want to be employed or have a very good track record as a business owner of income that's coming into you, and you're going to share your last 3 years of tax returns and your last 3 years of your W-2 if you're an employee. Finally, you're going to fill out something called a PFS, which is a personal financial statement. Now this is going to be broken up pretty much into two separate columns. The left-hand column is going to be all of your assets, home equity, your 401k, stocks you own, crypto you own, gold and silver, cash in your account, everything that's a positive. And on the right-hand side is going to be your liability column. Those are all your mortgages, that is your car loans, that is your credit card debt, your student debt. All of that is going to be listed on the right-hand side. And you're going to take this, you're going to add it up together, and it's going to show hopefully a positive number, and that's going to be your net worth. Now the bank is going to look at this. This is going to affect how much they're going to pre-qualify you for in a loan. Now on the pre-qualification letter that you're going to get from the SBA lender saying that, hey, we're willing to give you up to $1 million on a deal. This is not them guaranteeing they're giving you $1 million. This is just them saying, based off of what you've given us, we think that you would qualify to do a deal up to this size. But the largest part of the calculation on the SBA lender side is the actual business. If you bring a business that has amazing cash flow, has an amazing track record, has an amazing team, they're going to overlook a lot of the things on the personal side because the business is what they're giving the loan on, and you're going to be paying that loan back based on the proceeds from the business. And so the SBA lender is going to give a outsized portion of their calculation to the health of that business. And yes, you do factor in, but it's mostly on what skill sets do you bring that's going to be able to help in getting this business to grow and to make sure that they're making back payments on the loan that they just gave you. It is always shocking to most of the students in my community when they say, hey, look, I don't have the best PFS or personal financial statement. I've done this in the past. I've done that. I don't think I'll qualify for anything. And they go throughout the process and they actually end up qualifying for way more than they thought. We've actually not even had a student in the program that has not been qualified for some level of qualification for an SBA loan. If you think that you're the one person out there that can't qualify, I guarantee you we've had all different types and all different sizes come through. Going through the step-by-step process that we show, everyone is able to qualify for some level of support. Remember, the most important thing here is the business itself. You're going out there and finding a great deal, and that is going to be able to carry you through with most lenders to be able to get funding because they're focused on the deal and if that deal is going to be able to pay them back on their loan. Now, it's also really important to realize when you're talking about SBA loans, there's something called a personal guarantee. That means even though your LLC is taking on the loan, you as a person are personally guaranteeing it. So if you buy this business and that business ends up failing, you're on the hook for the payments to the SBA lender that gave you the loan. Now, let's say the payments are $20,000 a month and you can't pay that. Well, then you're going to have to negotiate with the SBA lender. And a lot of times the collateral that you put on your PFS, whether that's your home equity, whether that's the vehicle you own, whether that's a 401k account or a stock account, that could be used as collateral to pay back the SBA. There's no free lunch when it comes to business acquisitions. If you are getting money that's backed by the federal government, it's amazing. You're getting a crazy amount of leverage to be able to do these deals. But if your deal goes south, then you're on the hook. And that's something that you need to make sure that you're okay with and that you understand the risk for. Thankfully, the success rate of SBA loans over a 5-year period is 95+%. So we're talking about 5% of the deals that end up going bad and where the bank is having the conversation with the buyer. But you have to make sure you're going to every deal with the knowledge that that is a possibility, however remote it is, and making sure you're okay with the collateral that's going to be used to pay back the bank. So the first lender that I actually spend a lot of time with is Live Oak Bank. Now, Live Oak is the largest SBA lender in the entire country. They give out more loans and more volume than any other bank that's out there. So they have a lot of data across all different industries that they fund, which is great because I'm able to ask my lender about certain industries that I'm looking to invest in and what has been the data from it. He'll be able to say, the bank loves that industry because there's an amazing payback history and there's been very little defaults, or hey, that industry is getting more and more defaults. We're getting a little bit more shy about going in lending on a deal in that industry. So make sure you're using your lender not just as, hey, will you fund this deal? But that lender only gets paid on the deal if it goes through. So make sure you're using them to look at the deal, to analyze the deal, send the numbers when you get them in the confidential information memorandum, the CIM that you get from the seller's broker. Ask them to tell you how much they're willing to lend on that deal, and they'll tell you. And so you'll be able to use that specifically when you're going out there and trying to make an offer. So you know already how much the bank is willing to back you on a deal before you ever throw an offer out. So make sure you're getting your lender working with you as on your buy team. He is a part of your team to go out there and get your first acquisition done. So I already mentioned Live Oak, and I love working with them. They're one of the largest lenders, but at the end of the day, you need to work with the bank that's willing to give you the best deal. And every lender out there has a different way of going about structuring their financing, and the rates can vary. Now, they're not going to vary by 5% or 4%, but typically at some local banks, you'll be able to get currently around an 8.5% interest rate over a 10-year term, and other banks, you're going to be getting around a 10.5% interest rate. It all depends on the type of bank, whether or not they keep the loan on their own books, whether they sell the loan to other third parties, but definitely go out and shop your deal around to find the bank that's willing to work the most with you. Some of the other banks out there to use that are actually pretty good, that I have great experiences with, are Huntington Bank, also Customers Bank. Another great one is Byline Bank. There's literally 10 others that I can name that are all across the country, and they do lending specifically for small business acquisitions. Again, the most important thing is making a relationship with the lender to get your pre-qualification done. You're going to get that pre-qualification lender. I recommend using Live Oak Bank, and then you can go out there and use that as your proof of funds in your negotiations. But when it comes time to actually fund your deal, make sure that you are competing, sending it out to all these different bankers, get the best deal, get the one that's willing to work with you the most, and utilize them to go and get your deal funded. The next thing I want to talk about is setting the right expectations with the bank. The bank is going to be one of the most important partners with you on your acquisition journey. And you need to make sure from the first time you meet with them to the closing table that you are acting in a way that's professional, you're acting in a way that shows them that you're a low risk client, and that you're a person that's going to be able to get the deal done and do well with this business. So before you're even reaching out to the bank, you're coming up with something called your search narrative. This is the story about why you're getting into business acquisitions. The right answer is not, I just want to make money, because that is so simple. Everyone obviously wants to make money. Why do you want to go down the route of business acquisition, which is a very specific way about going and building wealth? Make sure you understand why. What's that driving force that's pushing you to do this? And then talk about your skill sets. If you're in sales, marketing, operations, whatever you're currently working in, how do those skill sets then apply to the business that you're going to be buying? And come up with your pitch, a 2-minute pitch about why you are a great person to do this and why the bank is going to be doing a great decision by backing you in your endeavor to buy your first business. Remember, the bank is looking at you the entire process as, how likely is this person to pay us back? And you want them to always say to themselves, this person seems reliable, they seem like they have the skill set necessary, they seem responsible, and I'm going to put my money that they are going to be able to pay us back over this next 10-year term or 25-year term or however long the term is for your loan. So remember, you're in a relationship. Every interaction you have, whether it's a phone call, Zoom call, in person, whatever it may be, you are making sure that you're always bringing confidence to the table. And that's not to say you can't ask your SBA lender questions. Throughout the process, when you find deals, absolutely utilize your SBA lender. Send them those deals you're interested in. They'll give you feedback from the bank's perspective, how much they'd be willing to fund on a deal. Use that, because that is critical information that you're going to be able to go out and use when you're negotiating to buy a business. But make sure, again, you're treating them as a professional partner, because again, you're always going to be going into their calculation as how much risk is this person in giving them potentially up to a $5 million loan. And you want to make sure that they always err on the side of it's a good bet. Now let's talk about the part of the process where the bank wants to work with you. They've given you their pre-qualification letter. You found a great deal. You brought it back to the bank. The bank gives you 2 thumbs up saying they love the deal. You make an offer with the bank's approval on the amount. The seller accepts the offer. You're now under contract, and now you're going into the diligence phase and the underwriting phase for the bank. So this is the phase of the SBA process where the lender now has got all the details files and they're giving it to their underwriters, and the underwriters are going through and doing all the diligence that the bank needs to do to make sure that they're willing to fund this deal. This process can take anywhere from 30 to 45 days. Sometimes it goes quicker, but always be prepared for it to go longer because that's normally what happens. So this is the part where they're going to ask you for a business plan. Now, before you start sweating profusely or getting worried about you don't know how to write a business plan, let's get to that in a second. The reason why they want a business plan is because outside of you saying, yes, I'm going to buy this HVAC or plumbing company or this accounting firm and I'm going to run it really well, that's one thing to say. It's another thing to lay out a plan. Remember, their job is to always evaluate you as risk. What level of risk are you bringing to this equation? The better your business plan shows, the more thought you put into this, which means that you're showing as a lower risk client. We want to make sure we spend a lot of time on this. As we talk about in our community all the time, we have people who do these business plans that are third parties. This is what they figure. They take all the financials of the business, they do the industry research, and they're able to come up with an amazing business plan to present to the bank. It's very imperative that even if you're not the one writing it, even if you have a professional write it for you, that you understand every single line of that business plan, because they're going to ask you about it. They're going to say, wow, your projections on here show that you're growing 10% year over year. Why do you think that's the case? If you've never read the business plan and you don't know the underlying assumptions for why they're giving that 10% projection, you're not going to be able to answer that question. Quick story on how I looked at my first business plan. The first time that I was asked to create one, I spent a huge amount of time. I remember it was weeks of just PowerPoint slides and presentation material and graphs and charts. And I ended up presenting it and the bank was like, wow, this is great. Thanks. And they asked me one or two questions and that was it. And I thought, why did I do all this work for them to really not even give it too much of a second glance? There's two reasons why this was important. One, it showed the lender that I had put in the effort, or that I had purchased it from someone else to put in the effort to do it. But two, I understood everything that was in it. And I did it myself the first time. Since then, I've never done it myself again. I found great third parties that are able to do it in a fraction of the time at a better quality than what I put together the first part. The banks love it, but you have to make sure that you understand every single aspect of that plan, because if you get called out on it or they ask you questions about it, you need to back it up with the reason the way it is. And if you need to change it, you can make changes before you present it to the lender. Don't make this more complicated than it has to be. You don't need to have an MBA. You don't need to have a business major. You don't need to know every aspect of finance, technically even how to read a financial statement. You just need to know what information you're putting out there. Part of the business plan is the projections category. If you've listened to some of my other content, and especially if you've been one of my students, you know that I don't give projections pretty much the time of day, because again, a projection is an educated guess. We have no idea what's going to happen in the future. We don't know what revenue is going to look like. And as far as valuing a business based off a projection, you never do it. The only way you value businesses is based on past performance, because that is data, that is fact. I can look at it. It's a number that's in a bank account somewhere that I can tie it back to. You never value a business off projections. Why does a bank want projections? Because they want you to go through the exercise of thinking through how you're able to grow this business. It's an exercise. It's you looking at past performance, looking at the things that contributed to this past performance, and how you're going to be able to take that and replicate it for future performance. They want to see that you're thinking not just, oh, the business is going to always do what it's always done. No, not necessarily. What are the things that made the business do what it did? And now can we take those things and now can we put them to where in the future the business continues to prosper, the business continues to grow. And if you're going to say that the business is going to all of a sudden increase at a growth rate, it's going to go from 2% year over year to 10% year over year, you have to give legitimate reasons why. You're going to spend X amount on Google Ads every month, which is going to drive X amount of leads, which is going to drive X amount of closes of new clients, which is going to generate X amount of new revenue. You have to show a logical progression of where these are coming from. Don't get carried away in your projections. Don't say, hey, once I buy this business, it's going to grow 100% month over month. Almost certainly it is not. And if it is, you have to give an amazing justification for why you think that is the case. Remember, we don't value businesses based off projections. The bank's going to ask you to create them, and you're going to create them backed by data. One of the easiest ways to find people who can do these business plans and do these projections for you is to go to Fiverr or to Upwork. Okay, you go on these websites, you go and create a profile, you go and search business projections or business plan, and you're going to see a bunch of people out there who do this. This is what they do for a living. They can do it 10 times better than you, and they can do it at 10 times the speed. They can also do it at a very low cost. So go out there, do the search, connect with them, have them come on board, do these projections, do these business plans for you. Remember, you're still responsible for it, so you have to understand every aspect of it, but don't think you have to go out there and spend weeks trying to figure out how to write this business plan or figure out how to do these financial projections. Get a pro to do it, take it back, learn it, ingest it so that you're going to be able to talk to someone about it when they ask you a question. Utilizing SBA loans is what's allowed me to leave my 9-to-5 working at JP Morgan and build a portfolio of cash flowing businesses, to leave my 9-to-5 and now make over $850,000 a year in cash flow so I can spend more time with my wife and with my kids. If you want to learn more about this, go and check out this video where I break down how to acquire these businesses. Thanks for watching and see you on the next one.